today, so we're going to get right into it. What we wanted to do on today's call is do a quick set of updates on things you need to know, quick breaking news, and then we're going to have Ramon Bullard from the NCRC to talk to us about the issues around using the Community Reinvestment Act and their complaint system there, the CRA file that each bank has as a way to really kind of change your relationship with banks and getting some effective action by using the tools of the CRA. And then we'll also do we'll have Elise Cohen from the National Consumer Law Center about the 4th anniversary of Dodd-Frank and what Dodd-Frank's impact has had on our work. So we'll have plenty of guest time. Oh, actually, I didn't mention also we have a quick talk about the latest HAWK development. The HAWK is actually a set of programs. It's not just one program, and HUD is considering rolling out a HAWK unit. There's one which was the FHA Back to Work program. The second one is the pre-purchase counseling one that we spent a lot of time on this call, and there'll be a new one they're looking at on modifications. So we'll give you a quick outline on that, and probably HUD will join us in the future to give more detail. But why don't we get started with our, and we'll do a plug around joining NHRC because you know, we're getting more members in. We're really glad groups are joining. This really helps our work a lot, and want to encourage more to join. It strengthens the work that we do, and we're working on improving the member experience a lot too. But great, let's go to federal funding. So Matthew, as our expert, what is happening or not out there?
Yeah, unfortunately, it's more what's not happening. The kind of latest news is it's looking increasingly unlikely that the Senate is going to pass a budget, which ordinarily we would. I mean, there should be some hand-wringing around there. There's still inability to get a budget passed, but for better, it is for the better for the housing counseling community at least. If they don't pass a budget, they'll do, I guess we're hearing a short-term continuing resolution, which will basically fund the government at current levels, because if both the House and Senate budgets they basically had a net decrease in funding between HUD Housing Counseling Assistance and NFMC, the end result would be actually higher funding than it would be if they managed to get their act together and pass a budget. So it's actually not bad news. So just to kind of recap the numbers, the current funding levels are $45 million for HUD Housing Counseling, $67 million for NFMC. The House and Senate passed between 47 and 49 for HUD Housing Counseling Assistance, so just a small increase, but a big decrease of $17 million to $50 million for NFMC. So, you know, not encouraging in that we do wish our elected officials could you know, get their acts together, but it is a good thing, at least in the short term. I haven't heard any numbers. I don't know if Bruce has in terms of how long they would likely do a CR for, but we're pretty sure it would not be for the full year. So it would, you know, be additional funding for some prorated portion of a year.
Yeah, we have no idea what they'll do on the CR side, yeah, in terms of timing, but how long it'll be.
I think that's all, though, to report on federal funding.
Okay, and do you want to do one more plug on looking for Republican allies?
Yeah, so this is kind of an ongoing thing, but we're going to keep bringing it up and hope to get more traction, and we do appreciate some folks have made some suggestions already. But if you have any ideas, so we're looking for any Republicans with whom we may be able to build you know, strong relationship going forward, or even a fairly strong relationship going forward. Just we're looking for folks on, you know, the other side of the aisle that we can work with and can occasionally champion housing counseling or, you know, specific programs that we're interested in. So I think there's kind of a few you know, categories these folks are likely to come from. It could be moderate Republicans, and we're especially concerned with the House. Although, you know, if you have suggestions for the Senate, we're open to them. And, you know, there obviously aren't a ton of moderate Republicans in the House, but You know, that would be one category of folks that may be willing to work with us. It could be folks in states that have been especially hard hit by the housing crisis, and states like Florida, New Jersey that still have high foreclosure numbers. Those folks, even if they're less moderate, may be willing to work with us on at least specific issues. And then, just anyone that you or your organization may already have a strong relationship with, or even just, again, you don't need to be best friends, but if there's someone that you work with and, has shown an interest in some support for housing counseling, we'd love to hear about them. And we have a few different ideas for things that we're going to do. We'll probably try to do some, especially during the August recess is coming right up, we'll try to do some in-district visits with some counseling agencies, with hopefully the rep or the congressperson or the senator. We'll probably also organize some kind of statewide phone calls with either members or staff. So a few things we're doing, but this is going to be, this is a long-term kind of vision, trying to foster relationships like the one that has fortunately been fostered with Congressman Dent up in the Lehigh Valley, that was pretty pivotal to getting that slight bump in funding for housing counseling.
That slight bump was worth $2 million, I'll just point out. And, it's just, these are million-dollar questions that we're talking about here. So it's very likely that you're counseling, some of the people you're counseling are people coming from Republican congressional districts. And to the extent that you can reach out to those offices and develop relationships, we've got them already, we would please tell Matthew, because this is a very important part of our kind of thinking about how we're going to fund housing counseling in the future. One of the pieces will always be federal funding, and we have actually had, in this current environment, lots of success because we've had some working relationships with Republicans. So let's strengthen that. Okay. So one other update is on the HAWK program. Oh, no, actually, wait a minute. We've got the survey first. So, Matthew, we've got a survey out, and we need more people responding, right? What's the story?
We do. We've had, a fairly good response so far. We just did a kind of interim report, a preliminary report, to kind of talk about some of the early findings. We had about 90 responses for that, so that's good. But I'd love to see us get up over 150 or 200. It's going to be open for at least a week, but I think it's going to be a good bit longer than that. We need to finalize with NCLR when it's going to be open until. But yeah, I mean, we can't stress enough how important this is. The preliminary report we just did, we sent to CFPB, and they've been asking us for feedback on the survey, because they're thinking about the mortgage servicing rules, and maybe coming up with some tweaks or some additions or things like that. So it's really rest assured that if you do this, it's for a good reason, and it's going to be put to use. And it's just really valuable hearing from you all who are in the field about what's happening. If you can share it with everyone in your office, really as widely as you can, that would be a huge help. If you can just forward it around as far as you can, we would really appreciate that. Unfortunately, you can't click the link on your screen there, I don't think, but I will circulate it after the call as well.
Great, and if you've got listservs of counselors in your state or your region, please circulate it there as well. We're really trying to figure out what's working and not working in the new CFPB servicing standards, and as Matthew said, CFPB is looking at this pretty closely. Good, let's just jump to the next slide. HAWK, hopefully you understand, actually HAWK is a term under which a number of different programs will come. It's homeowners armed with knowledge, and that's what HAWK stands for. And we have the Back to Work program, which is a HAWK initiative. We have the repurchase program for providing counseling for FHA mortgages, which we've talked about on the call previously. They're also looking at another program for FHA modifications, and we believe the description of kind of Lucy was given to me that it will mirror what Treasury does on the 1308 post-modification counseling program, and this will be specific for FHA loans. One nice aspect of this is that the program will they encourage servicers to respect existing relationships, which I think means that if a counseling agency counseled somebody on the modification, that there ought to be an attempt to work with them on post-modification counseling. We'll learn more about this, and we've invited HUD in to join us for a call, and hopefully they'll be in the August call. We're just working on the details, but to keep you informed, I just wanted to make sure that people knew that this was one more area that HUD is doing some innovation in, and these will be specific to FHA loans. Okay, so we have NCRC here today, Ramon Bullard, who is a senior regional organizer, and this is really about one of the concerns we've had, and many of you have raised, is the ability to get back to getting good lending done and improving access to credit and building relationships with lenders. And I mean, it's interesting. So NCRC obviously is a leading organization on working on community reinvestment issues, has done a lot of pioneering work in this field, and also has a deep understanding of the CRA, and has done a lot of great work in trying to improve and strengthen the CRA and the reporting data under which it's pinned, as well as many, many other issues. And we've been talking about how the CRA wasn't really as effective in the past few years, and David Birnbaum from NCRC pointed out that there's the comment letter issue in the CRA file, which is still a tool that we should think about using. So that all kind of rolled out to, boy, we ought to have NCRC on and get us set straight on what the opportunities are. So we're turning to the experts. So Ramon, are you with us? Okay, we're working on clicking him in. And okay, it looks like. So Ramon, are you there? Ramon, can you speak up? Okay, well, small technical problem. We'll keep trying and get him to connect. We actually had him here before the call started, so this shouldn't be that difficult. Well, while we're waiting,
can you hear me now?
Oh, good. Yes, we can. Okay, nice work. Okay, so Ramon, please take it away.
Okay, thank you so much. Thank you so much for having NCRC on the call. And you know, today what I'm going to do is just basically give a brief overview of how housing council agencies, but really any community organization, can be really active on community reinvestment advocacy. It's something that here at NCRC we've taken seriously and really have seen as an opportunity to do something about bank disinvestment or other issues that you're seeing in your community, take control of it. And so NCRC really has expanded our membership department now, and we now have 5 regional organizers and a department actually totally of 9 people working just on community reinvestment advocacy. And so happy to talk to you about this today. So let's go to the first slide. So, you know, a good bank can really be an anchor of a vibrant community. It can be as or more important to the success of the community as a good school or a hospital. Like some public institutions, banks actually have obligations, and one of their obligations is to make sure that they address community needs. Another obligation they actually have is to produce a public benefit, and this becomes really important in particular when a bank is merging or acquiring another institution, and we're going to touch upon that briefly later on. So the Community Reinvestment Act, or CRA as it's commonly called, actually establishes that banks have social responsibilities. They cannot just wash their hands of working class communities. They cannot just cherry pick the types of loans they want to have, or where they're going to make loans or investments. CRA was actually enacted in 1977 in response to a practice called redlining, or they refused to lend in certain neighborhoods. Literally, banks took a red pen, drew around entire neighborhoods, and said, we're not going to make a loan in that community. Obviously, this had a detrimental effect on the community, so in response, Congress passed CRA. And CRA actually establishes an affirmative obligation for banks to meet the credit needs of credit-worthy borrowers and businesses in low and moderate income communities. So this is really important because the obligation is really on the bank to meet that need. However, it is important that community organizations also become involved. So talking a little bit about the impact of CRA so far, we have seen that the benefits are clear and impressive. Since its passage in 1977, it is estimated that there have been more than $6 trillion in CRA agreements. A study done by Federal Reserve economists actually found that CRA agreements increased bank lending to minorities and LMI borrowers by 20%. From 1993 through 2002, and I'll point out that this was prior to the subprime lending crisis, lending to African Americans increased by 79.5%. 185.5% to Hispanics, and 90.6% to low-income borrowers. So clearly this is an impressive tool. However, as Bruce mentioned a little earlier in the call, the tool is only as effective as those people who are involved in making sure that it's working in the correct way. So as you can see, CRA can have an impact. However, banks don't always contribute to vibrant communities. If the past few years after the financial crisis have taught us anything, it's not only that banks did not produce a public benefit, but actually some of them caused incredible harm. The government and the public supported them to the tune of $23 trillion in loans, investments, and guarantees. So given the fact that it seems that the government's really backing the financial system, we really should make sure that the obligations of these banks are greater. It's time to raise the bar. It really is time to increase expectations. It's a new era for responsible banking work. And it's in this era that we really are looking for renewed and reinvigorated advocacy around the Community Reinvestment Act. So how does CRA work? Well, the basics of it are this. Every 2 to 5 years, banks are examined by their federal banking regulators. There are 3 of them. The Office of the Comptroller of the Currency, commonly known as the OCC, the Federal Reserve, known as the Fed, and the Federal Deposit Insurance Corporation. And this depends on where the bank is chartered, and you actually can find out about specifically financial institutions you're looking at, who they're chartered with, by going to www.ffiec.gov, and that's really the easiest way for you to find it out. And on that website, they will tell you the asset size of the bank and also where the bank is chartered. Another good resource also for information specifically about banks is also www.fdic.gov, so going to the FDIC's website, because they are the insurer of all federally chartered deposit institutions. They are really a good resource for you to find information as well. So after these examinations, banks get a grade. This grade can be very important to the bank, honestly depending on their size or what other activities they're looking, but in particular for banks that are looking to expand their operations, because it's used in mergers and acquisitions, and we'll talk more about that later on. So how do the examinations work? Well, as a part of the CRA exams, banks are rated on the extent to which they're meeting community needs. The examination period varies, but oftentimes it's 3 to 6 months for small and medium-sized banks, and longer for large banks. So someone along the lines of Bank of America could take a year or more to actually complete the evaluation and then have it released. There are 4 possible scores for CRA examination. The best score is outstanding, then there's satisfactory, needs to improve, and substantial noncompliance. The needs to improve and substantial noncompliance in particular are considered to be failing scores. So that's showing that the bank actually is not meeting community needs. So there are 3 main components to any CRA examination, and bear in mind, by the way, that this varies depending on the bank's asset size. So the smallest banks actually only have 1 test. The mid-sized banks only have 2, and then the largest banks actually have all 3 of these tests. So, and when we're talking about large financial institutions, we're really talking about banks with over asset size of $1 billion or more. So, the first area really is lending, and this is weighted more strongly than the other two areas, particularly because banks really, their main purpose is to lend. So typically on a CRA examination, it's giving half of the weight is in the lending category. So this lending looks at how the bank is meeting the lending needs of LMI communities and small businesses. And those are the two typical areas that are focused on. And then the second area is investments. So how is the bank investing in LMI communities? This typically looks at stuff related to, for example, are they investing low-income housing tax credits? Are they doing the directly or through a fund to build housing in your community? The third area is service, and this really looks at how the bank is meeting the needs for branches, deposits, and other products for low and moderate income communities. Other things which banks should get credit on this portion of the examination include, for example, serving on the board of one of your organizations. They get credit for doing something like that in the service portion of the examination. So now we're kind of getting to the heart of the matter really here, which is how do you comment? If you found out that there's a bank in your community that you really are concerned about and you want to comment on their performance, well, the first thing is you should know whether or not they're up for examination. Even though you technically can send in a comment to any of the federal banking, any of the regulators or to the banks directly, and it stays on their CRA public file, the best time to actually comment is right before the CRA examination. So one of the important things that you should look at is to look when the regulators put out who's up for examination this quarter. And NCRC is actually a great resource for this because something that we give to our members is a comprehensive list of all CRA examinations and all mergers and acquisitions and all branch closings that we have access to information to. So we call this our CRA Action Alert. And so obviously it can be a cumbersome task finding this information, but the places where you find it actually are these three websites, www.occ.gov for OCC National Chartered Banks. For Federal Reserve Banks, it's www.federalreserve.gov. And for FDIC banks, it's www.fdic.gov. And these banks that are under the FDIC are typically your smaller community institutions, though there are exceptions to that rule. So once you found out that the bank's up for examination, it is best to actually comment prior to the examination process really getting underway, because that's when your comments are going to be the most effective in the examination. So comments actually specifically focus on publicly available data. We find great resources to be the Home Mortgage Disclosure Act data, but also the small business lending data, branching data, anything that you can give numbers specifically to regulators will make your comments that much more impactful. And also it should specify areas of concern. What is it specifically that you think the bank isn't doing that they should be doing? And if at all, if you can, if you think back to what we talked about earlier, those three areas, lending, investments, and services, really you should specify which of those areas it falls under. Also another good thing to think about is look at the past bank's examination and how has their performance changed from one examination to another. So the last part really is that like I mentioned, any of the comments to the bank's CRA file should be sent directly to the bank's headquarters, but also should be copied to the regulators because you want to make sure that the regulators understand what your concerns were. They will see it when they go into the bank, but it's better to send it to them directly so they're armed with that information as they go in and question the banks on their performance. And the last thing I'll really mention is that we at NCRC really as Bruce is saying, really this is what we do on a daily basis. So we have many resources, including stock letters. We're always there to provide help and actually identify other members in your region who might be interested in CRA advocacy. And over the past 2 years or so, we really have turned up the number of comments that we've done. We actually just did a count and realized it was something in the range of 20 different banks that we've commented on in the past 2 to 3 years. So really, this is it's a good time to get involved and active in this. So on the last area that we're going to talk about is community involvement and why it's important to get involved. So regulators are actually required to take those comments that you take into account on their CRA examinations. The scores are taken into account whenever a bank applies to merge with another bank. So we spoke about public benefit earlier. There's two areas. One, CRA, which they have to look at. How do they do in their CRA performance? And if the bank had done really poorly on their CRA performance, then it would make it very, very difficult for them, or there might be conditions applied upon the merger about things that they need to do or areas that they need to that they need to improve in before they'd be allowed to merge. So it can be really important. And you know, when, the second area is this public benefit, which in a future day we can talk some more about, but really is related to what kind of products and services they're going to have. And so because of that, and really the importance of that, it really can mean building wealth in your community. And so that's what makes it really vitally important that you're active and involved. There are over 6,000 banks out there that are actually covered by CRA, and of those financial institutions, only a handful ever receive any comments at any point during the year. So the more you comment, the more that you're sending in feedback, the more you're specific with what you're saying, the more powerful it is, and the more you're helping your community. So really, I can't emphasize how much it really is important for you to get involved and active, and I'd be happy to take any questions.
So thank you. And I think in a practical sense for a housing counseling agency that's in Topeka, Kansas, there may be several banks in their community. They may have banks they have relationships with. They have banks that they don't have relationships with. In terms of filing a comment or getting involved in this process, how would they decide which bank to look at? And I think sometimes they're worried about alienating the bank and that sort of thing as a potential funder. I mean, so how do you think about all that?
Yeah, I mean, these are questions we really get on a daily basis, and quite honestly, every institution has its own different sets of circumstances that they need to weigh. But the first thing I would say is, commenting, even if it's going to be, we thought they did good on this one program, but really could improve in this area, still will help. Generally, our experience has been that when people comment, there actually is more support, not less, for their organization. And that really has been there. So the things to think about and really weigh are, who are the best and worst players? I think the easiest thing to think about is when you're looking out the landscape of all of the different financial institutions that are there, who's really doing the worst in your community? The second thing, and I think it's really important to think about, and people often overlook this, is that oftentimes in your community, maybe in Topeka, Kansas, the largest financial institution may be the one that you know the most about, that you're seeing out there in the papers every day. So the Bank of Americas of the world, the JP Morgans of the world. And you may think, oh, they're the ones doing a real bad job. But quite honestly, like I said, there are thousands of banks out there. And there's likely a regional or community financial institution in your community that's really not stepping up to the plate as well. So I would really encourage, the thing to do is is to really go and look at some of the ones that are based in your area, that are large in your region. And this has really been some of the big progress that NCRC has actually gotten, has been focusing in on some of those regional institutions, because they're looking, one, to grow, and two, they're that much more connected to the community. And in the past, they may not even have thought about CRA. I mean, we had a time where people have doubled or tripled their CRA staff just because we decided to push them and really do some advocacy around this. And so that can't do anything but actually help your organization. So, obviously those are decisions that are thought about for each housing counseling individual and their relationships balanced. But really, honestly, we've everyone that I've been involved in the past 2.5 years, we've actually seen support increase for people who got active and involved, particularly if you do it in a manner that really leads with the facts.
One of the things I think it's worth noting is that the senior management at a bank will see these letters. I mean, it gets elevated very quickly. Regulators will see it. That this becomes a very important piece in the regulatory conversation that any lender has. And if they have plans of opening a branch, which in some banks could be a very big deal, or acquisitions, all those sorts of things, that all comes into play. And I guess also the reviews that the bank goes through. So in some ways, if you're having difficulty getting a relationship with a lender, then you may be able to get a much better relationship by being a little more aggressive. And
absolutely. Yeah, absolutely. I agree with that statement 100%.
And when you do you have any thoughts about what the content should be in the letter that goes in?
Yeah, like I said on the earlier slide, when in terms of commenting, was it should always include specific data or specific areas of concern. So what is it that you're concerned about? Is it that you've been trying to counsel your first-time home buyers, and this bank doesn't have a first-time home buyer product, and so you feel that that's something that the bank should be doing that they don't have? So that ends up being a concern. Could be a concern under both the service and the lending test, for example, because that could be a product innovation they don't have that they should have. So, but then also it could be under lending, because that could be part of the reason why they're underperforming LMI borrowers.
Good. And we actually haven't gotten any questions here, so
okay.
Let me hang on a second.
Well, if you can put up the last slide too with my contact information, so if anybody.
Oh, good.
We'll also circulate after the call all the web addresses you mentioned and any links that you included, and we'll include your contact info as well in a follow-up email.
Okay, great.
Well, thank you so much, Ramon. This was very helpful, and certainly people should feel free to reach out directly to him or to people at NCRC for further guidance. They definitely are the experts in this field.
Okay, thank you so much. I really appreciate it.
Okay, good. All right. So
I'm going to jump in and say that we're thank you, Ramon. I'm going to say we're having a little bit of trouble with Elise. Elise, if you can hear me, I'm going to hang up and ask you to use the audio pin 36, and we'll see if that works. So if you may need to. Well, let me just hang up and we'll try that and see how that works.
Okay. So we have a logistical problem here. We're trying to catch up with Elise, but while we have some extra time, one of the things we're going to do next on our call in early August is we're going to look at the interest rate resets, and we are bringing in the Treasury Department. We've had a pretty substantial conversation that housing advocates have been having about how to best prepare for the resets and get people through it, where interest rates will go up for many of the borrowers after the 5 years of their modification has run out. And Treasury has, as one of their primary tools, is looking at Tier 2 counseling. Oh, we do have a lease. Okay, so we'll have Tier 2 HAMP mods as one of the solutions we can make available. So it looks like we've got Elise here. So I'll just come back to this at the end of the call. But Elise, can you hear us?
I can hear you, but I'm not sure you can hear me.
Excellent. We can now hear you. Exciting. Thank you for your patience here. So we've got the 4th year anniversary of Dodd-Frank. I'm sure there have been wild celebrating all around. And what we want to do is just have a little conversation with one of the leading housing advocacy experts in the country about how Dodd-Frank has impacted the housing work, especially the housing counseling work, and how it may have shaped what we have in the future and maybe what else needs to be done. So hopefully many of you know Elise. She's been highly influential in Dodd-Frank, in lots of the struggles we've had with Treasury, with lots of issues around the settlements, around the CFPB, FHFA. It's kind of a long list, DOJ, and it's probably a longer list than we should spend time on. And I should also say that Elise has been highly influential on many of the positions that NHRC has taken. She's always been a very thoughtful contributor, but also somebody who's really kept low-income people's issues at the front and center of all the discussions. So pleasure to have you here, Elise.
Bruce, it's a pleasure to be here. Can you hear me?
Clearly, yes. You're doing great.
Wonderful. So I just wasn't sure if my phone or my computer was the source of the information that you're getting. So everyone can hear me now. Is that right?
Yep, you're all good. You're all good.
Great.
So Dodd-Frank, here we are 4 years in. especially from a housing perspective, how has it impacted our work? Do you think it's working? What do we need to do?
Well, first of all, I just want to say I really appreciate the opportunity to be here and speak with all of you today. Everyone I talk to in Washington and everyone I work with knows that the only reason our work is meaningful and as high level as it is because A, we're doing it for people in the field, and B, it's informed by the experience of people in the field. And I will also say that, Bruce and HRC have been an invaluable partner in all of that work, because at any given moment someone will say, well, what's happening in real life? And Bruce is always the first person to know. And so that's been an enormous privilege to get to do that together for so long. So Dodd-Frank has been around for 4 years. I thought I would just take a moment to talk about life before Dodd-Frank to have us sort of appreciate a little more sort of where we are now. As many of you may remember, we had several rounds of unaffordable loans that were made to people in low-income communities after many periods of not really being able to get loans that were reasonable at all. Suddenly there was a huge influx of credit, not because people suddenly decided to be less discriminatory or out of the goodness of their heart, but because people on Wall Street figured out that you could make a lot of money by selling loans to people who were on the margins and then essentially selling them off where the performance of the loan was essentially less important to the parties who had first made the loan because they already got paid off. And then they could chop it up into pieces and figure out how to make money out of somebody else's misfortune, essentially by continuing to market them more loans because housing values kept going up in most neighborhoods. And in neighborhoods, as we all know, where they didn't go up, they could just fake the appraisals and continue to flip people as well. And so that was sort of where we were. The other thing that happened was in the 80s, they changed the tax rules so that interest was deductible on home mortgages, but not for a lot of other types of loans. And so it promoted more and more home equity lending. And so in the last iteration of abusive Wall Street-backed lending, what we saw was, the most recent version that everybody was talking about from 2004 on, where people got interest-only loans, and they got these no-doc loans, and then all of those people came into your offices trying to figure out what to do about those things. And so that's where we got Dodd-Frank. It didn't pass until 2010. And so these bad practices of the most recent vintage started 2004 to 2006. The market started to tank around 2008, and the bank bailout happened long before we got Dodd-Frank, and then we finally got Dodd-Frank in 2010. And it's done a bunch of very good things for us that we can talk about, and then we can talk a little bit about what more work there is to do. So the first thing it did, and sort of the most obvious thing that it did from the perspective of the housing counseling community and the low-income housing community in general, is it created a new government agency, the Consumer Financial Protection Bureau. It has a vast array of powers, which it uses with more or less of our approval depending on what they're doing, and sometimes we're more happy with them and sometimes less. But the bottom line is, it is their job to look out for consumers and homeowners and low-income people in all of those markets in a way that no other agency before was focused on. The banking agencies, the ones that you were just hearing about on the context of bringing a CRA concern or claim, or objection, are banking agencies whose first job is to take care of the safety and soundness of the banks, which essentially means making sure they can stay in business and that their balance sheet is good. And then secondarily, their job was to deal with consumer protection, and that was not really a workable solution because consumers were not really the priority, and therefore, while there was blatant abusive lending going on, the bank regulators didn't particularly find it or do anything about it, even when they were informed about it. And their systems weren't really set up to find it. And they were doing examinations of loans, and somehow they didn't see what we all saw. So in comes the Consumer Financial Protection Bureau. they have a wide variety of powers. One interesting aspect of it is that it's not run by a group of people from both political parties. It's run by one person who's appointed by the president. And so agencies with that structure tend to have a lot more, nimbleness, because they're not having like 5 people fight it out every time they want to make a decision about something. And so the CFPB has made a lot of progress on a variety of fronts. In the housing area, it has attorneys who can bring enforcement actions like the Attorney General could against companies who do things wrong. They also have supervision staff who for the first time are not only examining banks, they're also examining non-banks, including mortgage servicers. And they can go in and they take confidential actions in response to bad behavior they may see. The challenge with that is that we don't know what they're doing and we don't get to see it. On the other hand, it's better than not having them in there. And then there, is a complaint function, which some of you may know about, and we would encourage you to utilize, which is that if you have a client who's having a problem with a lender or a servicer or another type of entity, you can file a complaint on the CFPB website. Your client can do that. Bruce, I don't know if there's something specific to say about how housing counselors can interact with this consumer complaint function, but they will actually look into it, and if there's a dispute, they will seek to resolve that dispute.
So housing counselors have submitted the complaints for their client. There's a portal for doing all that, or it's the regular portal, and there's a place where you can go to submit for your client, and we know that these have worked in the past, and it's a good tool.
So that's another aspect of what the CFPB does. And then another thing they do there is they have a fair lending office. And so if you're seeing trends in your community where you think people are either being targeted for bad practices, whether it be on the lending side or after the loan is made, or they're being left out of something good, you can file a complaint, but that they have this fair lending function there, and that's something else that they're looking at. And that could be something where it's intentional, but much more often it's not, and it's just perhaps your observation that people in certain neighborhoods are getting access to certain types of resolutions and other people are not, for example. So that would be sort of one type of thing that one might be able to raise with them. And then finally, and sort of in some ways lately, the biggest role from the perspective of those of us in the housing community is they have a group of people who are writing new regulations. And these are regulations that are binding on lenders and servicers and other entities. And some of them are based on language that was specifically in Dodd-Frank, and other sets of those rules are not, and they're under other authority that the CFPB has to write regulations, either because it's part of an existing law, like the Real Estate Settlement Procedures Act, RESPA, where they did a lot of their mortgage servicing rules, which I'll talk about in a minute, or because they identify something as unfair or deceptive and they've concluded that they want to write a rule about that. They haven't used that authority in this context yet, but we look forward to seeing them do that. So what substantive protections, what better rules did we get out of Dodd-Frank? First, on the lending side, because this has a lot to do with what you're going to see walking into your office, now for the first time we have the pathetically obvious yet desperately needed rule that lenders can only make loans that people can afford. And the way the rule is structured, what it actually says is they have to, they have to do an evaluation to ensure affordability, which is a different question from whether the person can actually afford the loan. But they do have to make sure that they've looked at the ability to repay, and they can get special insulation from legal claims if they do a whole variety of more sustainable practices and make a so-called qualified mortgage, which includes things like verifying and documenting income, making sure the DTI doesn't go above 43%, not charging more than 3 points in fees except with certain exceptions. not using negative amortization. And so those are favored loans, and they're favored in different ways in the prime or subprime market, but essentially there are now rules that making a loan that's sustainable is an obligation of a lender. And so what I wanted to do before talking about servicing is to just really flag that for you, because right now everyone's very focused on mortgage servicing. They're very focused on what to do for people in foreclosure in terms of what are the requirements of the servicer, because most of the loans walking in the door were made before Dodd-Frank, and they certainly weren't made under the rules that only became effective more recently, January 2014, on these lending rules. But soon what's going to happen is loans are going to start being made that are covered by these rules, that were made more recently, and you are some of the first people who may see people defaulting with those new loans. You may also see that people aren't getting loans, and that's also a problem that we should certainly raise with government officials. But the flip side of the problem is there will be companies who say, I don't need that qualified mortgage protection. I'm going to make a bunch of loans without those better terms to people with damaged credit. And we don't know what those loans will look like. And those will be the next round of predatory loans, we fear. And we hope that the housing counseling community can work with other housing advocates to identify those trends early. And then we can nip them in the bud in a whole variety of ways. So that's one important thing that we got, and sort of an item on the to-do list for things that we should all be thinking about going forward. When I speak at conferences of advocates of various sorts, I keep hearing, well, we're not really seeing new loans yet. But I know that's temporary, so please keep us posted. The other key lending protection that came out of those rules was about brokers and loan officers and how they can be paid. And in the old days, they could be paid more to upcharge or upsell your client into a more expensive loan with worse terms. And generally speaking, that's no longer allowed. There are a variety of loopholes in the existing rule. For example, you can pay people through their retirement or bonus plans if you put it generically into everybody's rather than into one person's for upselling people. And so loopholes like that may mean that we all end up with clients who are still having those problems where they're getting worse loans than they qualified for, and worse loans because the person who gave them the loan got paid to give them the worst loan. So that's another thing to look out for going forward. And then I'd like to spend a few more minutes talking about servicing and then leave time for questions. There were a few small servicing protections that are in the Dodd-Frank Act related to information that people receive regularly, like they're on their monthly statements, and a few other small things. There's some very general protections on force-placed insurance. We were only allowed to get something in on that if we could negotiate with the insurance industry and they would agree to the language, which you can imagine.
I may be done being able to speak.
Bruce, I can hear you. Did you need me to do something different?
No, you're doing fine.
Okay. So, so there are a few very, very general provisions in there. However, the CFPB took it upon itself to put out a much broader and deeper set of servicing protections using their existing authority to write regulations, primarily under the Real Estate Settlement Procedures Act, which is the thing that requires the HUD-1, for example, for closings, and also some under the Truth in Lending Act. And the key thing to say about those protections, as you probably know, is they are completely procedural. They do not in any way entitle anyone to a loan modification, and they are very clear about that. And despite all of our best efforts, it seems unlikely that anytime soon the CFPB or really anyone else is going to require servicers to provide loan modification. That said, currently many of them are, and as long as HAMP is around, many of them appear to be providing even some very good affordable modifications to some groups of people, if not enough. And so the question is, well, what are those procedural protections? And there's a whole host of them. There are obviously a whole bunch of requirements about outreach early on in early intervention. There are requirements about not starting a foreclosure or not continuing a foreclosure depending on when you apply for the modification. If you get your complete application in prior to the 120 days, then you're not going to have to face foreclosure until they do the review. There are requirements about documenting denials, etc. So there are a whole bunch of requirements. There is a huge timeline, as you all probably know, about whether or not you get a posterior foreclosure if someone requests a loan modification review only once the foreclosure has started, etc. There are still many things that need to be done. One thing I would say is there are a bunch of rules that already exist, like I just described, that have loopholes in them or that are too weak. For example, you're only protected if you submit your complete application, more than 37 days prior to the scheduled sale, assuming the sale has been scheduled. You only get an appeal if you submit your request 90 days before that scheduled sale. And the other thing is you have to submit a so-called complete application, which can be a term that is essentially gamed by the servicers. So those are some sort of existing weaknesses in the rules that are there. The other very big weakness, which some people call second bite of the apple, and Bruce always reminds us it could be a third or fourth bite of the apple as well, is additional hardships. Your clients are only protected by even these simple procedural protections the first time they have a hardship on a loan. That is blatantly missing the boat here, because people who have hardships tend to have more than one in many cases, and it's something that we're all working on fixing. But for now, you're sort of stuck with that. And you're also stuck with this complete application rule. That's a very general type of rule. The servicers are being encouraged by the CFPB to interpret that broadly, and so you should be zealous in pushing them to do so. If they say, just send us in your information, arguably that's complete, even if they later tell you you need more. And then the question is, well, what else is it that we're trying to do on top of that? First, if you find that these rules are not being followed, please submit complaints to the CFPB. That will help, A, your client, and B, help us get changes in the rules. So in addition to these existing loopholes in the rule, there are some other areas that are kind of rising to the top. One of them is about special populations who are not getting access to proper servicing. One is borrowers with limited English proficiency, which we know many of you are seeing. There are a variety of rules about that in different places. They're all quite weak, and we are looking for more in addition to funding to promote better translation services through housing counseling agencies and otherwise. But there are expectations that some level of understanding should be provided to those people in terms of accepting translated documents or providing translated documents. It's harder to get oral interpretation simultaneously when you're on the phone. That's something we're pushing for more of, etc. Another area that we're seeing a lot of issues with is with regard to successors in interest, widows and orphans, and other people, even people who are divorced, and in some cases people who are not divorced but who may be a homeowner and who may have some sort of family separation issue. And there are more rules about that. They are not 100% there yet. Fannie and Freddie have some good rules. Fannie has the best rules. The CFPB has put out some guidance. We're pushing them to do more. FHA has some decent rules on that as well. And the goal here is that your client, who is a successor in interest, should be able to get reviewed for modification and get an answer about that modification before they take on the note, before they take on the obligations of the debt. Because if they're going to do an assumption, they have to know whether they're going to be able to afford it. We strongly encourage you to advocate for that for your clients and to let us know if you're seeing problems with that. Yes, Bruce?
So Elise, so on this specific one, so this is the situation where, and housing counselors see this all the time as well as plenty of other people, the note holder may be deceased, and then family members want to step in,
Yes.
a spouse who's not on the mortgage note, and what happened is the lender says, well, it says, you're not on the note, no, you can't do it, or then we'll do it, but can you afford to take over the mortgage? And no, they need a modification, but they won't do the transfer until the unless you can afford the note as it stands, and obviously you can't get the modification if you have to transfer it with a capacity to pay for the full note. And so in that situation, or successors in interest as you call it, so apparently the CFPB just put out a new set of rules that apply to all mortgages. Is that correct?
Well, they put out something that's very, very narrow. What happened was, remember earlier we were talking about the new ability to repay rules?
Mm-hmm.
Well, in that context, a couple of banks were saying that because this is a new loan and it's an assumption, the new loan can't just be reviewed as a modification. It has to meet the standard of the qualified mortgage and the ability to repay rules in order to be given to someone, and that a full underwriting needed to be done. For a variety of reasons, that's a ridiculous contention when it comes to an assumption that's not an arm's length assumption, that's just related to successors in interest, and we successfully got the CFPB to put out guidance saying that this was not necessary and you don't have to do full underwriting for people. They did sort of nod in that announcement to it would be good for servicers to fully review successors in interest. It's in everybody's interest to do that, but they didn't really say that servicers are required to do that, and we're still pushing them hard to do that, and we know that that's still being considered on the inside.
So they haven't completely solved the problem yet. So
no, but there are snippets in different places, but I think people should push hard and know that they have a right to push hard.
So push the servicer hard.
Yes.
Yeah.
Yes.
Right.
Yes. Housing counselors, homeowners, and other advocates should push the servicer to get an answer on the modification, and they should complain if they're not getting an answer, and complain everywhere they think they can and go over people's heads, because it doesn't make any sense, especially if you're only asking for a modification that's consistent with the investor's interest. Why wouldn't the investor want to do that?
It's always been extremely frustrating. So we're down. Do you have one more? This was great, totally comprehensive. Do you have a 1 more minute wrap up, and then we've got 1 more minute left to
I would
wrap
say
up.
transfers of servicing are something that are very big right now. The CFPB has put out some guidance about it. We know people applying for modifications are often getting lost in the mix. We encourage people to advocate for their clients hard on that they shouldn't have to reapply for mods, and also complain to the CFPB, because the more you complain, the more likely they are to act quickly on that. Thank you so much for having me.
Oh, it's great, Elise. And, Dodd-Frank is playing out, and it's pretty fascinating. It's obviously generating a lot of opposition from the right, but also we're seeing programs that are very, very helpful to people. And it's nowhere near where we want it to be, but we've made a lot of progress. So I'm going to quickly close out with a couple short comments on the call. So our next call will be on the 7th. We're going to have people from Treasury about the Tier 2 modifications and interest rate resets. So Tier 2 modifications have their problems, but we're going to need to think about this as a tool to solve very specific problems that people have that may be very helpful to a number of your clients. And what became clear to me is this whole idea that you have to raise your hand in order to get a Tier 2 modification in many cases, how we ought to make sure that we understand when it's useful to use for your clients and how it might be able to benefit them, and what the shortcomings are, so you have a pretty good sense of when to use it. But this may be able to help people who have forbearance balloons from the old HAMP. It could help people who in 09 and 010 and 2010, the principal reduction alternative wasn't available for loans that non-GSE loans. It's now available, so we should be looking at that for people who are in stuck situations. So we'll have Treasury to give us a rundown on that, and there's some places where it'll help with people with rate resets, though we we're still doing some work to try to get to be more useful to people. So, and we may have some update on the Hawk modification proposal as well. Talking to the Treasury about getting somebody on the call for that. But also wanted to just really encourage people to think about joining NHRC. We do have a good, vibrant membership. We're going to add a bunch of resources that are specific to NHRC members. You can still get the discounted credit reports, $12.25 for tri-merge credit reports. Most of us all are paying anywhere from $14 to $18 for the equivalent. These are all soft pull credit reports. And all those things are great, but you know, really the reason you join NHRC is you want to be able to support this work and support the movement. We need to have a stable, independent funding base in order to succeed, just like everybody else. We're actually doing quite well, but we need to be bigger. It's simple as that. And just sort of on a personal note, I was talking with Sarah Jarek about this Hawk modification proposal, and so this is on FHA loans, and she was describing the various parts, and you know, was thrilled to hear that they wanted to respect the existing relationship. So that idea that if you did the counseling on the loan to get the modification, you should be able to also get the post-mod work. So that's been our message, and it gets through. But the other interesting thing is they also added a piece where there will be a release which could be signed at closing, certainly can be signed before that, which basically would allow the servicer to send the case back, if there's a delinquency, send that client back to the counseling agency. Well, this is what we've been pushing for the last year and a half. Many of you were in meetings to try to get this. We got FHFA to implement this, and now FHA is adopting it. And the nice thing is this whole question about how do you integrate housing counseling into the business so that it's an automatic thing. Business flows to us. We don't have to be out there marketing and finding it all the time. We can spend more of our time counseling. Well, this is one of those components in that, and it's what the value you get by having people out there who are just focused on making sure that housing counseling becomes part of the system in a way that hasn't been in the past, and we're able to change things. So big thanks to the many groups who have joined. We just got a membership in today from a new group from Hagerstown Housing Development. We're very pleased that they've joined, and we are eager to get more to join and strengthen our work. So the next call will be, again, Thursday of next August 7th, so in 2 weeks. We'll be back on our regular schedule. Now in August, we won't do an end of August call because we understand some of you are on vacation, and that's cool. I mean, if there's an emergency, we'll jump in with something, but right now our plan is to do only one call in August, and we'll be back on our regular schedule in September. And we do actually have some pretty big things planned for September, so you should just mark your calendar for the first and third Thursday of the month, because we're lining up some pretty good guests in the beginning of the year, the beginning of the season. All right, thank you so much, everybody, and thanks again to NCRC and to Elise from NCLC for the good work they're doing and their participation. And we'll talk to you soon. Bye.